Hi, this is Mike Limbeck with Remax Commercial, bringing you today's Let's Talk About It. And today's article is Expiring Interest Rate Caps to Fuel Distressed Property Sales. It's based article based on the expiring interest rate caps on some of the loans that are out there on commercial properties, and it's hinting at we're going to have a lot of distressed properties hitting the market here this year in 2023 because of these rent caps and what the potential cost is for owners who have these loans that are going to be with the rent caps or the rate caps. An exponential increase in the cost of interest rate caps insurance that commercial real estate borrowers with floating rates purchase to hedge against rate increases may soon spawn a wave of property sales in an increasingly distressed market. And so not only are the current distressed market that we have experiencing, we have additional properties that could be added to this pool of distressed properties. So in 2019, the Mortgage Bankers Association estimated that up to 1/3 of all commercial property debt was floating rate. This is commercial properties, not residential, with most lenders requiring that borrowers hedge against an increase in the borrowing cost. So what has happened? Interest rates have increased recently, and this now it has increased the cost of borrowing and potential rate caps expiring, and then the need for a new loan to be put on the property at a higher interest rate than previously. When interest rates were low, derivative contracts offering hedges on multi-million-dollar mortgages could be purchased as low as $10,000. Now, as the lion's share of these insurance contracts are expiring, the cost of rate cap hedges is as much as 10 times higher than it was a year ago. So now you've got a higher cost for the rate caps that have expired and to set new ones, 10 times higher. So again, more cost to the current borrower and property owner. According to Michael Gigliotti, co-head of JLL Capital Markets in New York City office, many property owners may not have the liquidity to pay the increased insurance cost. Gigliotti told Wall Street Journal that he expects a surge in property sales this year from owners who choose to unload their assets rather than spend millions on a new rate cap. So there you have it from someone from JLL Capital Markets, quoting that this is potentially going to be drive a lot of property owners to sell. This is the margin call on the real estate industry, Gigliotti said, warning that a flood of properties going on the block to avoid increased rate cap costs could turn into what he called a first trigger, pushing down real estate values. So the commercial market could be the market instead of the residential like we had in 2008. The commercial market could be what sets off our property values declining. Apartment Owner Investors Management Group was cited as an example of the rate cap conundrum facing property owners in 2020. The firm took out a $24.4 million loan on a 300-unit multifamily property in San Antonio. The firm bought insurance that capped interest at 5%, with the hedge contract costing $22,000. Now, the cap on the San Antonio apartment complex expires in September. The company estimates the purchase of a new 2-year hedge will cost $1 million, or 40% of the property's annual net income. So there's no way that you can add that additional cost and have it be paid for with the cash flow of the building rising up to as much as 40% of the current property's net income. And then, according to a new report from Bloomberg, almost $175 billion of global real estate debt already is distressed, 4 times more than any other sector in the global economy. A wave of property sales spawned by the spiraling rate cap costs could magnify an already intensifying credit crisis in commercial real estate. So we haven't had much in the news as far as showing what's going on with the commercial real estate distressed market. And this is the first article I've seen out that showing that the commercial market is distressed. So, and there's potentially going to be even more distress coming with these rate cap expirations. Rising interest rates and the accompanying economic downturn, which appears to be the overture of a looming recession, have created an expanding pipeline of potentially defaulting loans in an environment where property values and cash flows are under pressure in all global markets. And this is from Bloomberg. They reported that just recently. So potentially we could have quite a few new foreclosures coming in the commercial market, which again didn't happen in 2008. Basically, the lenders kicked the can down the road back in when the residential market was imploding from the residential loans, and now we have a potentially commercial catastrophe coming with these distressed loans that could drive the economy and all real estate values down quite a bit. It could be anywhere from 20 to 40% reduction in values, depending upon the amount of foreclosures and distressed properties hitting the market all at the same time. So something to keep an eye on here in 2023. Need to see how many properties hit the market, what the loan amounts are, what type of discounts sellers have to make in order to avoid having this occur. So let me know your thoughts. Put some comments down below, and look forward to hearing from you. Need anything as far as any real estate needs, commercial real estate, multifamily specifically, feel free to reach out to me at any time. Look forward to hearing from you, and have a great day. Thanks.